The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast. That was interesting. There's a bunch of mutual fund companies applying to put ETF share classes into their mutual fund.
Keep people from leaving.
Vanguard's had them on for 20 years in their index funds. You could buy an ETF class inside, a Vanguard mutual fund, index mutual fund, and now they want a bunch more, and the SEC's got everybody on hold waiting to see what they're going to say, but because they already exist, they may be hard pressed not to say no. And it's just a matter of they want to keep that cash channel open, the mutual fund cash channel. So if they can put an ETF share class in there, well, it'll have an advantage to the shareholder. It will, not quite as big as if they just bought an ETF instead of the ETF share class of a mutual fund. But that's, to me anyway, that's really the death knell of mutual funds altogether. If you're going to put ETFs as a share class in your mutual fund, your mutual fund's cooked. It's better. People are going to just buy the ETF.
Well, as the article that you found indicates, there are some reasons why a few investors who have been there a long time may not make the change, because it could create.
If you don't want to sell it, if you have a huge capital gain in there, yeah, maybe you just want to sit on it. It's better off to have the ETF shares there. Maybe you're leaving it all to somebody in your will. You're never going to sell it. Okay, take the ETF shares.
So the question is, why would you sell, particularly if you know that you're sitting here in the beginning of a bull market? There's really no reason to sell if you have some sort of plan, you've process that you followed. The question that we addressed in a prior podcast is that this is a new market with a new foundation, the artificial intelligence foundation, and it has disrupted everything from investing to how to operate a business to how you're going to pay your taxes. Probably what hasn't been disrupted very much is government. It's a slow adopter to any sense of new reality. But other than that, this is a new paradigm for investing, and it reemphasizes the need to have a set of rules that even if you're a mutual fund investor, maybe there are some times where you thin out your position and pay a little bit of capital gains tax so that you can be more broadly diversified or more focused as the marketplace becomes more clearly evaluated and understood. Because right now, nobody understands the whole impact, the extent of the impact of artificial intelligence.
Correct.
And your mutual fund, though it's a diversified product, can't concentrate on the new industries that are getting the most benefit. Part of which is because they try to minimize the tax issue for their fund holders, and if they start selling stuff to buy what's working now, they're going to pass through a tax liability at the end of the year, and investors don't like that. That's the reason for the ETF share. The other thing that changes is people get worried about what goes on in an election year. And in my entire life, I've never seen an election year like the one we're going through this year. This one's unique. But I did hear I did hear a quote from Richard Nixon. He was under a lot of pressure to resign.
Not recently, I bet.
Yeah, right. Well, actually, I heard the quote recently, but he hasn't said anything recently.
Right.
But he was under pressure to resign because of the Watergate break-in. And the quote was Richard Nixon said, Well, the public ought to have a right to know whether or not the president is a crook.
Right,
All
right.
right, you think we ought to know whether or not our president is a crook?
There we go.
How timely. I'd forgotten all about that one. Anyway, when it comes down to presidential elections, it's really a function of, are you a trader or an investor? If you're a trader, there's lots of news that's going to impact your decision, some of which, as you get more experience, you're going to say, yeah, that's an emotional deal. It's no big deal. It will wash out in another news cycle fairly quickly, and you ignore it. Maybe it's not that insignificant, and you pay attention to it, so you trade. But if you're an investor and you're looking at 5 and 10 and 20 years out for how you're running
Right.
your portfolio and what your strategy is, political years are irrelevant. They wash themselves out. And what a survey that I read this morning basically said that Democrats are optimistic when a Democrat's in the White House, and Republicans are optimistic when a Republican's in the White House.
There
but
we go. There
but
we
that's
go.
going to change every couple of years. And even if you like the party that's in the House, in the White House, you may not like what they're doing in the White House.
Right.
So,
How's that for verifying recency bias, right? It's like, what are we doing right now? Yeah.
so as far as election year affecting your investments this year, forget about it. Focus on what's actually happening with the investments you have, or if you're rotating, what's going on with the ones that are under consideration. In one of our portfolios that was traded today, we we were looking at choices that were doing very well, but when it came time to pull the plug, the trigger, and say, let's buy that, you do a little extra work and find out that there are not very many people that agree with you by the number of shares that are trading, or the share cost, the spread between bid and ask is just
Right.
outrageous. You're saying
Yep.
something that's doing well, it's a leader in terms of performance, should attract money. It should be a magnet for money from investors, and yet it's not. There has to be something else. So what do you do with it? You step aside. Actually, you take it off your list and say, something that does that well, that has that big a spread and has so few buyers in it, isn't worth spending my time on to come back to it later. If it does something really important, it'll pop up in the headlines again. Then you go take another look at it. But get it out of your screening tool. Change the
But
criteria that you're looking
that's why it's so important to track the data. And that data is important. What is the fund actually doing? How many people are actually buying it? What's not important is, who does it look like is going to win the presidency? That should not ever be part of your decision making process for anything going into or coming out of your portfolio. There are too many important things that you can track and get real metrics on, and you don't have to worry about, who's gonna win the presidential election, and then what's everybody's reaction going to be to who wins. That's the only thing that really matters. What's the market going to do? Once it gets that far down the rabbit hole, you can't figure it out anyway. There's no reason to go there. Track real data, and that's number one. It's easier to see, and it's going to be way more accurate in helping you make decisions on what should be in or out of your portfolio.
Well, I think one of the important criteria that many investors get caught up with in error is the storyline. And
Oh yeah,
since we build portfolios on ETFs, the ETF sponsors have what we refer to as wholesalers who call us and say, look at this great deal that we have, and look at the future for wind farms or for solar farms or for green energy in general, or EVs. Those are all popular ones. Or how
you
we're
bet.
going to change this industry around, and this is coming downstream. And sometimes that just simply buys into people's prejudices about their own political, or in the case of green energy, their own personal goals and what they think is socially acceptable or socially proper. The
Right.
problem is that those particular concept investments may not be magnets for money, and other investors aren't going to follow through. So you may simply be saying, that's a great story, I'm going to put my money there. Well, because you don't have any target for when it's supposed to happen, you're willing to stay and wait. What if it's 10 or 20 years before the story comes to fruition? Or the other thing happens is not enough investors agree with you and it gets closed down. They just send you your money back and it hasn't grown at all. Or worse,
Happens. Yeah.
they close it down and you don't get all your money back, which is why data is the new gold in investing. It's the new gold for companies. They need data for their own planning, and
Yep.
anybody who can collect that data, process it, and put it in a form that makes decisions easier is going to be a big winner. So there's a there's a concept. Find the companies that are doing that data processing. We've
Right.
already talked on another podcast about NVIDIA. They're making that kind of stuff happen. But when it comes to your own portfolio, you need to look at where the data comes from and how can you process it. What are your rules? We use charts to do that. You can scan through charts and list, but there's lots of different services that will do that for you if you're running your own portfolio. And if not, you probably need somebody who can explain how and why they're making the decisions on your behalf and that they are, in
Right.
fact, fiduciaries in every circumstance, which we are.
And even if the story sounds incredible, even if it does sound like, well, this is can't miss, this is just going to be fantastic. Take the time, take the extra step, go look at some data. Is it attracting money? Are lots of people buying it? That'll let you know whether that's something you can follow through on or not. So if you're going to look at a headline, only let you lead you generally to a sector, and then you have to dig down and see if there are real money metrics in there that say, yep, money's being made here, they're attracting money, this is a place I want my investment to be. But you make that decision based on the money metrics involved, not on the headline.
Well, there's a couple of areas. Value investing is one, and gold investing is another that people
Sure.
buy into from a concept standpoint. Uh,
Yep.
Back in summer of 2011, we were on the radio and said gold has peaked. I mean, we're just looking at charts. So it had nothing to do with inflation, which wasn't a problem. It just
Right.
simply was looking at the charts, and the charts showed a loss of interest by investors. And it wasn't until just recently, in the past few months, that gold got
Yep.
back up to the 2011 high. That's a long time period.
You
That's
bet.
a, that's that's more than a decade of sitting there and waiting for something to work. Emerging markets are another one that the financial services community has been promoting as undervalued, great value buy for the last several years. Well, it's continued to head lower. So when you're a value buyer, the risk is it's going to be an even bigger value in the months or years ahead. The question is, how do you make that decision? And that's why we stay with leadership. If it's not working and it's not at the top of the list, we just basically don't want it in our portfolios. When it starts falling downstream, other things are stronger. Other things are better, stronger magnets for money from investors. That's where you rotate into. Frankly, we have no long-term commitments to anything in the portfolio.
Nope.
The only
It
the
doesn't
only
it doesn't bode
exception,
well. Go ahead, Don.
yeah, the only exception is a client brings in a position that they've had long-term and
Yep.
said, we want to talk about when this gets sold. I understand I'm overweight and I'm over risked. So we need to do something about that. But other than that, persistence in the portfolio should be persistent generation of benefit instead of, well, my dad gave this stock to me and he worked for the company and he retired there and it always did well for him. Maybe so, but there's undoubtedly a business cycle that will collapse at some point in time. And it makes no sense for your financial welfare to continue hanging on to something that is in a shrinking business cycle that can
Right.
last for a decade.
A long, long time. And it doesn't matter how good the story is. if it's losing money, it's time to part company, and don't get emotionally attached to any holding. Anything you buy, you should be knowing when you're going to be ready to sell it. And that doesn't mean you hate it. That doesn't mean it stays gone out of your portfolio. It's just going to not show up again until it's doing well. And then that's how you own strength. And more importantly, avoid the weakness. Stay out of the weak stuff in the market. And sometimes you can get trapped there by listening to a narrative. And it's like, well, that sounds like this should be great. Is it? Check the prices, check the volume, who's buying it, what's going on. If money's leaving, don't follow it. You don't want your money to be leaving.
I think that's a wrap for us, Perry. Our contact information follows. You want information, you want to have a discussion about something you own, give us a call or send us an email. We'll be glad to spend some time with you.